Let's talk about what happened during the pandemic, because that is when a lot of people saw lower interest rates and they would go to open houses and you would have like 13 or 14 couples standing in line at an open house, and how that affected what's going on right now in the market. So the rising interest rates that we've seen now versus what was going on during the pandemic have caused a completely different kind of pressure. So what you have is very challenging and also compressed assumptions that are being made in underwriting. So we have to be very careful because the underwriters are being very particular right now, making sure that there's no missing documents, that, one area of, for instance, in San Diego, you might have one area that's outperforming another area. Hannah and I talked about that in one of our videos that we did recently. Carlsbad is outperforming most of San Diego County right now versus, flat 1% here in the metro area. They're up to 6 or 7% in Carlsbad in these years where the interest rates are higher. And then what we have to talk about is we're not just looking at an investment for, the S&P going up, let's say the past 2 years or 6 months or whatever. You can focus on that, of course, because that is actually what's happening. But what they're not telling you is what the overall range or the overall value of this investment versus that investment is. So in 2010, an S&P 500 that would have outperformed real estate during the same period is a valid claim, because they're talking about 2010, it would have outperformed real estate over the same period. But then we wanted to test that using a California focused lens, because that could mean, they were looking at real estate over the whole country, blah, blah, blah. But here in California, let's say if I live in San Francisco and I have invested across California and the rest of the US for decades. So we're going to just say since 2010, I've been in the market, right? For this analysis, what we did was we modeled an acquisition of a single family home in California in 2010, and then we normalized it to about a $100K purchase price. So, you're talking about a condo in 2010, probably outside of the city somewhere or somewhere like that. But we did it for numbers' sake so that you could get a good idea. 20% down payment with a 30-year fixed mortgage at 4.69% would have a 5% gross rent yield a year and a 1.5% annual operating expense. So you would have like almost a 30-year straight line depreciation, which means you're taking the value of what the money has done over the years and you're depreciating the value, even though the house is still there and it's gaining value. You haven't really added a whole lot of remodels or refurbishments to it. So you're taking the depreciation, and you would get about a 40% effective tax shield. So you're not going to get that in the S&P. So now we're talking about what actually matters. We used FHA all across California, FHFA all across California for transactions for the home price appreciation, and then investor finances at each time with a lower interest rate. So you do have to be active, because we're talking about an active investor versus a passive investor. You do have to be active, but you only have to be active in several ways in real estate. You don't have to be watching every day. You need to be watching what the interest rates are doing. Right now, they're back down in the 5%. For those of you that bought last year or the year before and you had 6.5, you should be looking at remodeling or refinancing, remodeling the loan, basically, maybe remodeling the house if you got a little bit of money coming from your taxes. But the outcome from that just scenario that we just gave you would be the net wealth from this real estate investment would be double what a passive investment in the S&P 500 would be from 2010 to right now. So from 2010 to right now in California, real estate has doubled what the value of the S&P 500 would yield to the investor, okay? So this assumes that at that time we made no renovations, we added no ADUs, which the cities are huge on ADUs right now. So if you're buying, you want to think about having a lot where you can add a ADU. It means accessory dwelling unit, and no really active management, just market average performance with some above average assets, and operated the property a little bit more strategically, and the returns would have been even stronger. So this is just strictly somebody who's not super active, right? So if you want to talk about how that works over the 15-year horizon, the average California single-family home has still outperformed the S&P 500. It's the same way in a lot of other places like New York, places where there's really good jobs and people can, move easily into the suburbs and still get back and forth to work in the city. So if we extended that analysis from 10-year period since 1980, only 2 of 45 of those years did the S&P outperform California single-family home rates. So out of the last 45 years, only 2 years total did the S&P 500 outperform real estate in California. So if you're in California, you need to be thinking about real estate. It is the time for buyers to be looking at this now before the interest rates go down, so you have a plan. You should be looking right now. It doesn't matter how much money you've got. Call us, text us, email us, DM us. You have to be able to have an honest conversation with us so we can refer you to the right program and the right lender, because there are programs out there for everybody. Yes, you might have to live in a neighborhood that you don't want to live in for 2 to 3 years, or you're going to be a little bit farther away from the beach that you want to be, but you have to make some type of sacrifice when you're looking at getting into investments. It's not always easy to get in, especially in high-performing areas like California, but it doesn't mean that it's not possible. Let us help you turn the impossible into possible by just having a conversation about where you want to go. You got to play to get ahead in this game.